Good morning and welcome to the Deep Dive. We're here to take the markets, well, really high-stakes moments and just break them down. Make them essential, actionable knowledge for you.
That's right.
And our focus today, well, is captured from the earliest morning analysis, October 28th, 2025. And our sources are calling it an everything, everywhere, all at once week, which sounds intense.
It is intense, and the briefing this morning, it shows this almost impossible market paradox. That's really the core of our mission today, unpacking that.
Okay, so what's the paradox?
We are looking at the big picture, right? The index futures, and they show extreme indecision, almost total stasis. You know, U.S. futures are just trading mixed to flat, maximum investor uncertainty.
Right, sort of holding their breath.
Exactly. But then you scratch just beneath that surface, that apparent calm, and you find explosive moves, double-digit catalyst-driven moves in individual stocks.
Wow.
It's a true tale of two markets playing out at the exact same time. And we need to figure out what engine is driving that micro-volatility while the macro picture just sits there, paralyzed.
Yeah, looking at the data from, around 6:15 a.m. Eastern, you see that paralysis so clearly. The DOW is up, barely, 0.13%.
Whiny.
NASDAQ, up 0.03%. It's hardly moving. And the S&P 500 futures, they're actually down a tick, 0.01% in the red.
Index immobility, that's the word for it.
But it's a really high-stakes stillness, isn't it? Because the whole financial world seems to be held hostage by these two massive events just looming.
Absolutely looming. The first one is that gauntlet of mega cap tech earnings. Can't overstate this. This week we get Microsoft, Alphabet, Amazon.
The big one.
The absolute core, the beating heart of the Magnificent Seven.
Yeah.
And if these stocks don't deliver, well, near perfection, this whole rally could unravel pretty fast. They are under immense pressure to justify where the market is trading right now, these high valuations.
And the second risk, also huge.
The second non-negotiable risk is the FOMC, the Fed decision on Wednesday. Now, the market has already priced in a 25 basis point rate cut. It's like 98% certain, according to our sources.
So the cut itself is almost irrelevant.
Almost completely irrelevant. The focus has shifted entirely. It's all about the forward guidance. What does the Fed say about December? Do they sound confident about inflation or nervous? That's what everyone's waiting for.
Okay, let's unpack this high-stakes pause then. Starting with the big picture. Why are the indices so flat? Especially after hitting record highs just yesterday.
Right.
We saw the S&P 500 close above 6,800. Officially. For the first time ever. That was Monday.
Yeah, and that 6,800 level, it's huge. Psychologically, technically, it signals really powerful momentum.
So why the dead stop this morning?
It really boils down to rational risk management. Let's spend a moment on 6,800, though. Breaking that level, it suggests the bullish momentum is, well, profound. Maybe driven by those sustained capital inflows that talk about a U.S.-China trade deal getting better. It wasn't just a small gain yesterday. It was broad-based, powerful. And now, right after that, investors are simply unwilling to place big directional bets ahead of the Fed and ahead of Amazon's numbers.
Makes sense.
They're waiting. They need those definitive catalysts. So this flatness, it isn't necessarily bearish. It's strategic. It's consolidation. People are holding positions, maybe hedging volatility, just waiting for the signal.
And you really see just how rigid that waiting game is in the futures data. We mentioned the tiny moves earlier, but it bears repeating. Fractions of a percent movement across all major U.S. indices. Institutional money is just sitting on its hands.
Waiting for the bell, waiting for the news. Index stability bordering on, outright immobility.
And what about globally? Does the rest of the world look the same?
Well, what's fascinating is the global picture kind of mirrors this indecision, but, and this is instructive for you listening, there are a few really strong regional contrasts. Tells us where the specific risks are.
Okay.
Look at Asia. They closed mostly lower. The Nikkei in Japan down 0.6%. Korea's Kospi down 0.8%. Primarily profit-taking, They had powerful runs, hit recent record highs. So this looks like a logical, sort of non-panicked sell-off, just taking some money off the table ahead of this massive week. Makes sense.
But Europe's different. You mentioned fragmentation.
Yeah, Europe is where the fragmentation really kicks in. Indices there are trading mixed to lower. And there was a very clear negative catalyst out of Germany, Europe's biggest economy.
What was that?
The German GfK Consumer Confidence Index, it came in way worse than expected, minus 24.1. The consensus was looking for minus 22.0.
Ouch, that's a big miss.
It's a significant miss, and it signals deepening pessimism among German consumers, right as we head into the critical holiday spending season, too.
And that's hitting their market.
Directly. weighing heavily on the German DAX index, pushing it down between, say, 0.3% and 0.5%. When the biggest economy in the bloc shows that kind of consumer fear, it puts huge pressure on the European Central Bank, too. Raises worries about stagnation, maybe deflation, ahead of their own meeting on Thursday.
But wait, amidst all that gloom in Germany, the UK's FTSE 100, it's actually up. Slightly positive.
Yeah, holding positive territory, up maybe 0.05% to 0.1%, a clear countersignal.
How is London managing that?
It seems to be entirely down to strong company-specific news. Specifically, a boost from financials after HSBC raised its guidance on net interest income. And this is the crucial theme we really need to internalize today. Strong, fundamental, company-specific news can be enough to counteract even pretty significant negative regional macro sentiment.
So the message is?
The message is clear. Whether you look internationally or here at home, we are firmly in a stock picker's market. Macro noise is everywhere, but micro performance, individual company performance, is being aggressively rewarded.
Okay, let's shift gears then. Look at the market's traditional anchors, bonds and commodities. What story are they telling about inflation right now? Because it looks like they're all pointing down towards disinflation.
They are, which definitely gives the Fed some cover, politically and economically.
Right.
But it raises an important question for you, the listener. How is the market interpreting these falling commodity prices? Is it a warning sign, weak global demand, recession maybe? Or is it the Goldilocks scenario?
Explain Goldilocks in this context.
Goldilocks here means inflation is cooling off nicely, just right, without crushing economic growth. And right now, given the stability in bonds and the softness in commodities, the market is overwhelmingly choosing the bullish Goldilocks interpretation, which is good for stocks.
And that bullish view comes because both key commodities, oil and gold, are lower.
Exactly. WTI crude oil is down pretty sharply, 1.6% to around $60.30 a barrel. Gold is also down, new 2-week lows.
So why is that bullish? Falling gold, falling oil?
Well, there's a dual interpretation. First, gold. It's a safe haven, right? Its decline is being attributed to positive developments in U.S.-China trade talks.
Less risk, less need for gold.
Precisely. If global political risk seems lower, you don't need the hedge, makes investors more comfortable moving into riskier things like equities. Second, and maybe more importantly, that 1.6% drop in crude oil, that's a clear, undeniable disinflationary signal.
And that's key for the Fed.
Absolutely key for the macro calm. It essentially gives the Fed a clear runway to do that 25 basis point rate cut on Wednesday without worrying too much that they're immediately reigniting inflation. It eases the pressure on them, lets them focus on the forward path, not just defending the cut itself.
And the bond market agrees.
It seems to. The stability in fixed income is critical here. The 10-year U.S. Treasury yield is just holding steady, right around 3.978%.
Which means?
It means the bond market isn't panicking about inflation. It's not worried about the Fed making a mistake with this cut, at least not yet. It's calmly anticipating the cut.
Yeah.
And that stability is the foundation allowing these high stock valuations to persist. If the 10-year yield were spiking, this whole picture would look very different, much riskier.
Okay, so stable anchors, supportive. But the U.S. consumer is still the big question mark today, right? What are we watching on the domestic economic calendar?
Absolutely. The consumer drives so much. Today's main domestic catalyst is the Conference Board Consumer Confidence Index. That's out at 10:00 a.m. Eastern.
What's expected?
Consensus is looking for a little dip, down to 93.2 from 94.2 previously. This will be the key read today on the immediate health, the mood of the U.S. consumer.
And if it misses badly, like that German number.
A big miss here. Yeah, that could definitely cool things off quickly, regardless of any positive earnings news. It would suggest maybe that high-end spending that's been driving things is starting to dry up.
We also get housing data earlier, 9:00 a.m.
Yep. S&P Case-Shiller Home Price Index, also the House Price Index. Housing isn't the main driver it once was, maybe, but it's crucial context. We're looking for continued low single-digit growth, maybe around 1.9% year over year for Case-Shiller.
Tells us if the Fed's past hikes are still biting.
Exactly. Are those earlier rate hikes still crushing the middle-class balance sheet, even as we start talking about cuts? It's an important piece of the puzzle.
Okay. Now, for the really interesting part you said.
Yeah.
Where the flat indices just don't tell the story at all.
Right. This is the micro explosion.
We've got multiple stocks, high-profile ones, moving double digits right now.
Yeah.
This volatility, it points to some powerful, single-theme driving behavior, just drowning out that macro quiet we talked about.
And if you connect the dots, the market is aggressively, almost violently rewarding one specific behavior right now. Margin expansion. How?
Yeah.
Through radical efficiency and cost cutting.
So it's not just about growth anymore.
It's a shift in priority. It's not just grow the top line at any cost. It's about protecting profits, operational discipline, showing management will take painful steps, frankly, to secure those margins.
And the poster child for this today is UPS, United Parcel Service.
Undisputed poster child. They're surging, check this, plus 17.9% pre-market. Unbelievable move.
Why? What do they report?
They posted an earnings beat that just demolished consensus. Adjusted EPS came in at $1.74. The street was looking for something like $1.30, maybe $1.31.
That's a massive beat. But why did they beat? You said it wasn't demand.
That's the critical insight. The beat was not driven by booming demand. Volumes were actually soft. Analyst sentiment was pretty negative going into the report because of weak volumes. Their U.S. domestic segment revenue actually declined 2.6%.
So how do they do it?
Purely through rigorous internal efficiency. They have this strategy called Efficiency Reimagined, and it delivered, get this, $2.2 billion in cost savings year to date.
$2.2 billion. That's huge.
Now, the source material is specific. It was accomplished partly by cutting the operational workforce by roughly 34,000 positions in the first 9 months of 2025.
Wow. 34,000 jobs.
Yeah. And that is the definitive blueprint for 2025, apparently. The market is cheering management's ability to slash costs so aggressively that it more than offsets macro headwinds like slowing volume.
And their outlook.
Solidified it. They expect to run the most efficient peak in our history in Q4 with adjusted operating margin between 11.0% and 11.5%, just reinforcing that efficiency message.
So this massive UPS move, it kind of sets the narrative for the whole week then.
Absolutely. It provides the perfect positive lens through which the market is now viewing the other huge corporate news this morning, Amazon's layoffs.
Right. The reports that Amazon is starting its largest job cuts in the company's history this week, affecting 30,000 employees.
Exactly, 30,000.
Okay, wait, let me just push back a little here, though. Why are we so sure the market sees 30,000 job cuts as a good thing? Couldn't that signal real underlying weakness? Especially in their retail business? I mean, a layoff that big, if demand is collapsing, shouldn't that be bearish?
That is a critical question, and you're right to ask. If Amazon were, say, just an industrial company, yes, layoffs that size would scream cyclical weakness, severe weakness.
But because it's Amazon.
But the market, especially right after seeing this UPS reaction, views Amazon through this lens of efficiency, margins. The interpretation right now is that these 30,000 cuts are not primarily a sign of weak demand. They're seen as a bullish signal. Management is finally getting serious about margin expansion ahead of their earnings report on Thursday. UPS just provided the real-world proof. Aggressive, decisive cost cutting leads to massive shareholder reward, even if revenue looks a bit soft near term.
So focus on profitability over just market share.
Exactly. If Amazon can prove that shift, the stock likely reacts positively, despite the headline job losses. It's the UPS playbook.
Okay, that explains the really aggressive moves. But what about, say, United Health, UNH? They also reported beat expectations, raised guidance. But the stock reaction is much more muted, up only about 1%.
Yeah, UNH is up just plus 0.96%, and it's really instructive why. They did beat Q3 consensus. They did raise full-year adjusted earnings guidance to at least $16.25 per share from at least $16.
Right.
That's a classic beat and raise. Normally, yeah, you'd expect a bigger pop.
So why the lukewarm reaction?
Probably two things going on. First, the options market might have already priced in a bigger move. Expectations were high, maybe around a plus or minus 6.2% move was baked in. So the news wasn't a huge shock. Second, and this is important, their GAAP numbers, the generally accepted accounting principles numbers looked messy. The GAAP profit showed a big decrease compared to last year, even though the adjusted EPS, the operating number, looked good.
The adjusted versus GAAP confusion. Explain that quickly.
Right. Adjusted EPS usually strips out things like one-time charges, non-cash stuff, maybe restructuring costs, litigation reserves, things that aren't core operations. So the adjusted number showed the underlying business is strong. But the headline GAAP number looked weak, and that might confuse some automated trading systems or just give investors pause. Tale of two reports, basically.
Got it. Unlike the clear-cut UPS story.
Exactly. Now, briefly on the losers and the sheer speculation. Beyond Meat, BYND, is down sharply, almost 9%. Negative pre-announcement. Further sales decay, compressed margins. It's basically the exact opposite of UPS. Royal Caribbean, RCL, also down about 0.7%. That's a weak signal for consumer leisure, especially ahead of bookings report tonight.
And then there's the wild stuff.
Oh yeah, the everywhere all at once speculation. This is where rational investing meets, well, momentum mania. Incredible moves. BioKey International, BKYI, exploding. Up plus 146.8%. Just wow.
Insane.
And Strive, AST, up over 31% on absolutely massive volume, like 256 million shares traded pre-market, apparently fueled by social media, news about its legal officer, Vivek Ramaswamy.
So it just confirms the fragmentation?
Totally confirms it. You've got smart money, laser-focused on efficiency, and then you've got speculative money just running wild, treating this like a casino on certain names.
Okay, let's pivot then to the week's biggest structural theme. Big tech earnings. You mentioned the pressure already. Given where the market's valued, they face an incredibly high bar right now.
Incredibly high. And that bar has been raised even higher because the Q3 earnings season overall has been, frankly, phenomenal so far.
Phenomenal.
Well, about 29% of the S&P 500 has reported, and the EPS beat rate is sitting at 87%.
87% beat estimates.
87%. That's way above the 10-year average of 75%. And the blended year-over-year earnings growth rate for the quarter is tracking at plus 9.2%. Solid growth. And that strength is what's supporting this rally.
But here's the problem, right? The valuation.
Here's the critical valuation problem that you need to keep in mind. That strength is supporting an S&P 500 trading at a forward 12-month PE ratio of 22.7.
Okay, 22.7. Put that in context for us.
Right. Price to earnings, PE. How much are investors paying today for each dollar of expected future earnings? 22.7 is significantly above the 5-year average, which is around 19.9, and way above the 10-year average of 18.6.
So expensive territory.
Definitely expensive territory. And that high PE ratio is basically banking on the idea that the Magnificent Seven, the core of the index, won't just meet expectations, but will dramatically accelerate this already strong earnings growth picture.
Which means for Amazon and Microsoft this week.
The implication is crystal clear. Given that 87% beat rate across the market, a simple inline report just meeting expectations, that will be seen as a disappointment, a big one.
They have to beat and raise guidance.
They must beat consensus earnings. And critically, they must raise forward guidance, especially guidance around the holiday season, anything less. And that 22.7 PE starts looking shaky.
Okay, so before we get to the giants, we have a crucial consumer test after the bell tonight, right?
Yes. 2 absolute bellwethers reporting after the close today. They give us the clearest read on consumer health right now. Visa, V, and Booking Holdings, BKNG.
Okay, Visa first. What's the expectation?
For Visa, consensus is looking for EPS around $2.97 on revenue of $10.6 billion. That's roughly 9–10% growth year over year. Analysts seem fairly optimistic. Zacks noted a positive earnings ESP, meaning recent estimate revisions have been trending up.
And what are we looking for in the Visa report?
This is the purest global read on the consumer's health, you know? Are payment volumes still high? Is transaction growth holding up across borders? It tells us if the consumer is still strong enough to power through or if higher credit costs are finally starting to pinch.
And then Booking Holdings, the travel giant.
Yeah, BKNG. Consensus there is for EPS near $96.10 on revenue of $8.7 billion. This is the key read on high-end discretionary services spending, travel.
Which has been strong,
But the pressure is intense. We know other consumer internet peers reported recently and then sold off, even if they met expectations. Booking needs a flawless report. They need to show sustained margin growth, clear visibility into travel demand for next year. Otherwise, it could face a similar fate.
So these two tonight really set the stage.
Vital precursor to the big tech gauntlet, sets the psychological tone for Wednesday and Thursday.
Okay, looking ahead then to the Titans, Microsoft on Wednesday. What's the focus?
Incredibly sharp focus for Microsoft. Analysts watching 2 main things. First, Azure, the cloud business. Is that capacity constraint issue fading? They spent a ton of money. The market needs reassurance. Cloud growth can pick up again, especially compared to rivals.
And second thing, AI.
Second, exactly, AI. The market needs to see green shoots. Some early data on monetizing Copilot. Microsoft's huge capital spending, which keeps going up, is being justified by the promise of AI products. If they can't show some early, meaningful revenue coming from that investment,
then the spending looks premature.
Precisely. And the stock could get hit even if the headline numbers look okay.
And Amazon on Thursday. Critical report, especially after the layoff news today.
Absolutely critical. The layoff news primes the market for that efficiency story. They face three key questions, really. First, the AWS outlook, their cloud cash cow. There are rising concerns it might be losing market share, or at least growth is slowing faster than expected as customers try to save money.
Okay, AWS outlook, second.
Second, the holiday spending outlook. This is the big one. Most watched forward-looking metric, not just for Amazon, but for all of retail. Their guidance dictates how investors feel about consumer spending for the next couple of months.
And third, margins, tying back to the layoffs.
Third, margins. Ties directly back to that UPS blueprint we discussed. Commentary on the 30,000 layoffs, progress on efficiency gains. That will be paramount. If they show margin expansion offsetting any softness in revenue, the stock probably gets rewarded, just like UPS.
Okay, before we wrap up and synthesize all this, you mentioned a timing trap, a non-obvious risk related to the macro events this week.
Yes, we absolutely have to talk about the sequencing here, because it presents a significant volatility risk for you, the listener. It's what we're calling the Fed data disconnect.
Okay, explain the disconnect.
It raises this really important question about policy, right? What happens when the Fed makes a decision based on information that gets immediately, maybe violently contradicted by newer, more important data just hours later?
That sounds problematic.
It's the specific timing trap we have this week, and it almost guarantees volatility later in the week.
So lay out the sequence for us.
Okay. The Fed decision, that 25 basis point cut everyone expects, that happens Wednesday. It's 98% priced in. But the Fed is basing that decision, and crucially, their statement on future plans, on older data, like the September CPI report. They have to look backward to some extent.
Right.
The problem, the structural issue, is that the two most important, most forward-looking data releases this week, they come after the Fed decision.
Which ones are those?
Q3 U.S. GDP growth, that's on Thursday. And then the big one, the core PCE price index, that's Friday.
Core PCE. Remind us why that's the Fed's favorite.
Right. Unlike the CPI number that gets all the headlines, the core PCE strips out volatile food and energy prices. It gives a cleaner read on the underlying inflation trend. That's why the Fed trusts it more for policy.
So the Fed acts Wednesday, but their preferred inflation gauge comes out Friday. That is awkward timing.
It creates the volatility trap. Here's scenario one. Market loves the rate cut on Wednesday. Indices push higher. Optimism flows. Scenario two, the trap springs. That celebration gets hit smack in the face by hotter than expected GDP growth on Thursday, or much worse, a hotter than expected core PCE number on Friday.
And a consequence if that happens.
Immediate and potentially devastating for these high market valuations. A hot PCE number right after a rate cut makes that cut instantly look like a policy error. Like the Fed cut rates based on an outdated, overly rosy view of inflation.
And if the market smells a policy error.
A consensus for more rate cuts evaporates, instantly questioned. And that likely triggers a rapid spike in Treasury yields, which in turn unwinds all the dovish assumptions holding up these high stock valuations.
So that 22.7 PE.
Suddenly looks drastically overvalued, demands a swift, potentially painful correction, this disconnect, this timing trap, arguably the biggest non-earnings risk for the market this week.
Okay, a lot to process there. So let's try to synthesize this everything everywhere all at once market picture for today.
Right. Today is clearly defined by that tale of two narratives. On one hand, you have index paralysis, driven by huge macro event risk the Fed, big tech earnings.
Total gridlock at the top.
Total gridlock. But on the other hand, you have this intense individual stock volatility, driven by sharp micro-level company execution, or lack thereof.
And within that volatility, the main theme is?
The dominant theme, undeniably, is the market's singular focus right now on rewarding margin expansion via efficiency. Above all else, the UPS model, huge surge, driven by cost cuts, job reductions, that's the blueprint. That's the lens for viewing Amazon's layoffs, too.
It's not just growth, it's profitable growth through discipline.
Exactly. Fundamentals matter, but showing operational discipline, that seems to matter most right now.
So the push-pull dynamic is incredibly tight heading into the middle of the week.
Super tight. On the bullish side, you've got that exceptionally strong Q3 earnings season, 87% beat rate. That sets a high floor. You've got bellwethers like UNH and UPS beating and raising. And of course, that almost certain Fed rate cut Wednesday provides support.
But the bearish forces are strong too.
Profoundly powerful. Valuations are historically stretched. That 22.7x PE demands perfection from big tech. Key macro data, especially out of Germany, is weakening. Global growth looks shaky. And most concerning, maybe, is that dangerous timing trap Fed acting before the crucial inflation data.
And tonight, after the bell, we get that first real test of the consumer with Visa and Booking Holdings. That sets the tone.
Sets the tone for the whole tech gauntlet.
Which leads us, I guess, to our final provocative thought for you, the listener, to consider.
Yeah, the critical question really is this. Will the consumer strength we might see from Visa and Booking tonight, will that be enough? Enough to justify holding these stretched historic valuations if the data on Thursday and Friday shows the Fed just cut rates based on an outdated inflation reality?
Because if the market thinks the Fed is behind the curve,
Then even perfect earnings from big tech might not be enough to prevent a sharp repricing. So what stands out to you as the biggest, maybe the most underestimated risk this week, something to think about?
definitely something to think about. That's our deep dive for this complex market morning. Stay informed, stay safe out there.
And we'll catch you on the next deep dive.